any other investment, but real estate in particular is cyclical, and real estate markets are cyclical. And they are highly dependent on employment and economic trends, and vulnerable to capital flows and supply side risk. And so you have to understand where you are in a market cycle and how each of those factors, the demand side issues of employment and economic trends, the supply side risk, and the pricing risk that gets overlaid in terms of capital flows, you have to understand where you are in the market cycle and adjust everything. You have to adjust your strategy. You have to adjust your deal capitalization. You have to adjust how you're executing your business plans accordingly. I think one of the things that maybe sets us apart from many investment managers is that, Jim and I and Paladin, we've been through a lot of cycles in our careers. Jim had a 20-year career before starting Paladin with me nearly 30 years ago, and I had similar almost 10 years of experience. And so, we don't buy into now this time is different without a lot of skepticism. And so that gives good perspective for a firm like Paladin. And particularly being involved in multiple markets, we can see how cycles affect markets differently, different product types differently. And so we can see that, there's certain, if you're pursuing a strategy that's underpinned by a resilient demand driver, whether it's demographics or just the lack of affordable housing here in Los Angeles. Look at this year as an example. So coming into the beginning of this year, 2022, the economy was firing on all cylinders. The labor market was getting much tighter. You were seeing a lot of pent-up demand as we came out of the pandemic lockdowns. And you also saw supply chain bottlenecks, and you saw labor shortages. And so you saw inflation starting to tick up this year to the highest level I think it's been in my lifetime, at least in 40 years. You saw a war break out in Europe, and the ripple effect that has had on energy prices, inflation, interest rates, economic uncertainty, and so forth, rising interest rates in response to rising inflation. And you've definitely have seen economic growth moderate this year as a result of all of those factors. So in terms of where I think we're poised now halfway through or 2/3 of the way through 2022, it feels to me like we're a little bit in extra innings, whether it's the housing market or the economy as a whole. And so what we're doing, and we're hearing a lot of other investors do, is pursuing more defensive strategies right now. And we're hearing it across all classes, not just real estate. I'd be very wary of starting any new development project, any new construction right now, unless it is a pre-leased Amazon distribution facility and you've got a guaranteed maximum price contract, so you've kind of de-risked that proposition. But to do any kind of speculative new development right now is probably a risk that Paladin's not willing to take. There's also some bigger trends, though, going to that paradigm shift. Maybe there is a little paradigm shift going on, some mega trends that are disrupting certain real estate sectors, and those are being caused by technology, whether it's Uber or Zoom. It's outsourcing is contributing to it. Automation is contributing to it. It's really mostly technology driven. And examples of that are the negative effect that, the Amazon effect is having two effects, one positive, one negative. It's having a negative effect on shopping centers and retailers. It's having a potentially positive effect on smaller retailers who are able to expand their marketplace beyond just a walk up on a street. So certain smaller retailers are actually benefiting from selling their merchandise on the Amazon marketplace. Clearly turning industrial and warehouse distribution space and last mile industrial into very, very hot markets. Office buildings before the pandemic were already starting to look and operate more like hotels with shorter term leases and amenities that you don't normally associate with an office building, like free fitness centers and Starbucks and delis and just lounge areas in hotel lobbies. You think the WeWork's business model was trying to exploit and capitalize on that trend. Unfortunately, I think the business model didn't work that well for landlords, but office buildings, the pandemic accelerated that whole effect of office buildings becoming a little bit more like a short-term flex space. And I think that as a result, there's a lot of winners and losers, depending on the product type and the market that folks are focusing on. And there's a lot of smart folks out there that are trying to capitalize on the creative destruction, if you want to call it that, that's taking place in certain real estate sectors like retail and office and hotels. But that's never been Paladin's focus. We have always been, I think, a little bit more defensive oriented in what we're targeting. We like strategies that are first and foremost demand driven, that generate really good returns in good times, but also remain resilient during downturns. And that's one of the things that has caused us to focus in all of our markets pretty significantly on workforce housing, because those are tenants or buyers by necessity, not by choice, and in what is an essential asset, residential real estate for them. They don't have the choice that the professional worker had during the pandemic of working from home and connecting via Zoom. You have to live somewhere. You can't live via Zoom.